Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
After listening to today's news, you'll know, first, Canada's strategic patience strategy freezes US trade talks, risking a fragmented Western auto front against rising Chinese EV imports. So we'll discuss why Canada's newfound economic resilience is changing North American trade dynamics and what it means for the global auto industry. Second, Dutch government seizes Chinese-owned chipmaker Nexperia, testing the EU's de-risking strategy and threatening Europe's auto supply chain. We'll explore how this aggressive use of national security powers could reshape foreign investment rules and tech supply chains across Europe. Third, $1.2 trillion crypto market plunge tests institutional investors as Bitcoin's high correlation with the Nasdaq shatters its safe haven status. In this episode, we'll break down the risk of a corporate doom loop and what the first major outflows from Bitcoin ETFs signal for investors. The story begins with a decision that caught everyone by surprise. The United States just suspended all trade talks with Canada, a move triggered by a single anti-tariff advertisement. But anyone expecting Ottawa to scramble back to the table is in for a shock. In a stunning turn, Canadian Prime Minister Mark Carney just told the world that discussions will resume only, quote, when it's appropriate. He then doubled down on the cool-headed stance, stating directly to reporters, I don't have a burning issue to speak with the president about right now. After President Donald Trump terminated discussions, Canada's response wasn't a plea for reconciliation, but a signal that they have other priorities. This isn't just a spontaneous reaction, you know? It's part of a deliberate long-term strategy that analysts are calling strategic patience. Canada has been actively working for years to reduce its economic dependence on the US by expanding trade with other regions. And for the first time, recent data shows that Canada's imports from the rest of the world now make up 50.4% of its total, officially exceeding imports from the United States. This growing diversification is the foundation of their confidence. Carney added, when America wants to come back and have the discussions on the trade side, we will have those discussions. He noted that while conversations would likely happen within 2 weeks, Canada is, quote, very busy with the future of Canada and with new partnerships. The core conflict here is massive. Canada is actively seeking relief from punishing US import tariffs on its steel, aluminum, and auto industries. The suspension of talks puts all of that on ice. This internal North American squabbling presents a fascinating duality. On one side, you have allies haggling over tariffs, while on the other, it potentially undermines a united front against the rising tide of Chinese electric vehicle imports. A fragmented Western response makes it easier for Chinese EV brands to enter the market, which could disrupt the global auto landscape for everyone. This is no longer a simple trade negotiation. It has escalated into a public test of wills. It signals a bigger shift in how these conflicts are handled. In the past, leaders might have used a forum like the G20 to de-escalate quietly, but the casual way these talks were deferred shows these large multilateral groups are becoming less effective at solving major bilateral disputes. The result? Economic conflicts are increasingly resolved through raw public leverage, which adds a lot more volatility for global trade and investment. With critical industries caught in the crossfire, both leaders have now drawn their lines in the sand. So, looking ahead, we should keep a close eye on Canada's key economic indicators. For example, Canada's industrial capacity utilisation rate recently came in higher than expected at 82.5%. This suggests their industries are more resilient to these tariffs than many believed, likely by finding new markets. If this resilience holds, it could give the Canadian dollar more stability and even support stocks in their industrial sector. This economic strength is the real foundation for Canada's bold diplomatic stance. We were just talking about a major trade standoff in North America, and that theme of economic leverage is escalating over in Europe's tech sector. A high-stakes showdown is erupting in the global semiconductor industry, as the Dutch government has moved to take control of Nexperia, a Netherlands-based chip subsidiary owned by Chinese semiconductor company Wingtech. And this move isn't happening in a vacuum. Actually, it's a crucial test of the European Union's broader de-risking strategy. You see, the EU established a framework back in 2020 for its member states to screen foreign direct investments on the grounds of national security. The Dutch government is one of the first to use these powers so aggressively, invoking a Cold War-era law called the Goods Availability Act, setting a major precedent for how Chinese investment in Europe's strategic tech sectors will be treated from now on. Wingtech is now launching a full-scale legal appeal, firing back with an incendiary accusation. In documents seen by Reuters, its lawyers call the government's action an unprecedented and disproportionate deprivation of property and are demanding the order be revoked entirely. So, what triggered this government intervention? The Dutch state says the move was necessary to prevent Nexperia's former CEO and Wingtech's founder, Zhang Shuizheng, from moving the company's European operations to China. However, if you zoom out, you'll see another layer of strategy at play. The Nexperia case suggests that the old playbook for some Chinese companies, often called national champions of growing by acquiring overseas technology, is now breaking down. For years, the fast track to technological advancement was to buy a foreign company with the tech you needed. But with governments now willing to step in even after an acquisition is complete, that path is becoming much slower and riskier. This forces a pivot to indigenous R&D, which is more expensive and takes much longer. This is where the situation takes a more complex turn. The conflict has already escalated in the courts. In a separate action, a Dutch court ordered the removal of that same CEO for mismanagement after the state argued there was a considerable risk that Wingtech would not adhere to the government's intervention. Believe it or not, this represents a new and more surgical tool for what some call techno-nationalism. Previously, governments would block a foreign company from buying a sensitive asset, but here they are using domestic corporate governance laws to dismantle foreign control of a existing times asset by citing mismanagement. It's a significant escalation that creates huge uncertainty for multinational companies. Now, there's a fragile truce. The Dutch government recently suspended its intervention following what it called constructive talks with China, but it did not revoke the initial takeover decision, a move that China's Commerce Ministry says falls short of what it demanded. This translates abstract geopolitical risk into very real, tangible problems. For example, Nexperia is a major supplier of essential chips for the automotive industry. A disruption there could mean production delays for major European car makers like Volkswagen and BMW. This has become a direct confrontation over the control of critical technology and the future of the global chip supply chain. The focal point now shifts to China's response. We should expect it to move beyond diplomatic protests to more targeted, asymmetric retaliation. Keep an eye on China's export control policies, especially for critical materials like gallium and germanium, which are essential for chip making. Any tightening of these exports would be a clear signal of escalating trade friction with the EU. Speaking of risk rippling through entire sectors, let's turn to the financial markets. Let's start with a single statistic that might just change your entire perspective on the crypto market. $1.2 trillion. That's how much value has been wiped from the entire crypto market in just 6 weeks, according to data from CoinGecko. Bitcoin is leading the charge downwards, plunging to a 7-month low and closing in on the $80,000 level. This erases all of its gains for the year, a stunning reversal from its record high above $120,000 just last month. But this isn't just about individual traders getting nervous. The real drama is unfolding inside corporate treasuries. And what really brought this to a head was the sheer amount of institutional money that has poured in. As one analyst at Spectra Markets put it, the procyclical nature of Bitcoin treasury companies is fully obvious now. They buy high and now some of them are selling low. Take a company like Strategy, a major corporate holder of Bitcoin. Their average purchase price is around $66,000 per coin. As the price falls, they get closer to that cost basis. If it drops below that, they are officially in the red on their massive bet. So the thing is, this creates what economists call a doom loop, a vicious cycle where falling prices could force them to sell, and that very selling pushes the price of Bitcoin down even further for everyone else. Standard Chartered estimates that a drop below $90,000 for Bitcoin could leave half of these companies' holdings underwater. Big corporate players like Strategy have seen their shares tank 61% since their peak, and it's not just corporate treasuries. Interestingly enough, the new Bitcoin ETFs, which were the main engine of this year's bull market, are also facing a critical test. The average purchase price for Bitcoin within these ETFs is estimated to be around $80,000. Now that the market is falling below this level, we are seeing significant outflows for the first time, with over $1 billion pulled out in a single week. The key question now is whether these ETF investors are long-term believers or short-term speculators who will run for the exits. This is more than a crypto story. It's a canary in the coal mine for risk across all markets. The correlation between Bitcoin and the tech-heavy Nasdaq 100 stock index has recently surged to 0.8. A correlation of 1 means two assets move in perfect lockstep. So 0.8 is incredibly high. And it shatters the old idea that Bitcoin is a safe haven separate from the stock market. What's happening to Bitcoin right now is a powerful signal for what could happen to tech stocks next. An analyst at IG issued a stark warning saying that if Bitcoin's fall is a signal about overall risk sentiment, then things could start to get really, really ugly. And that's the concern now. The market is scarred by a recent single-day slump that liquidated over $19 billion in positions. While no one is officially calling it a new crypto winter, one market president offered a chilling reminder of history. Past Bitcoin sell-offs have seen prices drop 75 to 80%. A repeat of that pattern could see Bitcoin plunge to as low as $25,000. The big unknown is whether the new institutional money will act as a stabilizing force or if their leverage bets will actually make the crash even more severe.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.